Well, we're fully prepped now for a rate hiking cycle and quantitative tightening, it seems. The bond market has clearly taken notice. We're seeing opportunity all over the shop. Big drawdowns coming through in technology stocks and in the Russell. Gold and silver are going the opposite way. It's time to assess the trade-off. Well, hi there, my name's Chris Weston, I'm Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. We're going to be unpacking, we're going to be analysing, navigating all the landmines, trends and setups from this mad world of trading. And there are plenty of them there. There's some big themes that we need to get amongst it today. So remember, if you do like what you're hearing, smash the like button, we'd appreciate that as well. And let's get going with the programme today. I think it's a really interesting situation that we've got in markets. I think before we go anywhere, but I want to bring Blake into the programme. Are you with us, Blake?
I'm here.
There you
are.
How
are you doing, Chris?
Before we go into the markets, I just thought we'd just go for a couple of things that really caught my eye. First of all, Somalian pirates have created their own stock exchange. So they're basically being able to fund their unscrupulous behaviours effectively by going out into the market and getting funding. I thought that was a really quite a funny situation too. I'm not sure if you've got any sort of seed capital going onto that one as well. And another interesting article, which is really relevant as well, because what we're going to be talking about throughout today's show is that one of the ETF providers have just created what they call a breakfast ETF, controlling coffee, orange juice and pork as well, lean hogs, should we say. And I thought that was quite an interesting one because it really brings out thematic a lot of stuff that I hope that we're going to be talking about as well. So again, is that something that's on your radar? Is it something that you're going to be diving deep into going forward?
Well, it depends. As far as the breakfast ETF, how heavy weighted is coffee? Because it better be like very heavily weighted for a breakfast ETF. That would be one. And, you know, when you talk about Somali pirate exchange, well, haven't they already been doing that with Bitcoin for like years?
There he is.
Oh, that's gotta hurt. Oh,
there he is. Well, I want to catch on because the agricultural space is just super hot at the moment, and there's some great opportunities in what for a lot of people is quite a niche asset class, a niche part of the market, unless you're a trend follower. And there's just so much to talk about it. So let's go straight into the program. Let's go into Topical Funder and discuss some of these thematics. Well, Blake, look, we've got bond markets. Bond markets are front and centre with your trading the NZDUSD, with your trading the Russell. Yeah, we're looking at what's happening in gold and silver, and we're going to focus a lot on those in a moment. But, you know, you can't escape at the moment. The rates market, if you look at Fed funds futures are priced, you know, not just a full rate hike for the March meeting, but there's some people out there saying, should we be discussing a 50 basis point hike from the Federal Reserve? In the March meeting? That's only a couple of months away. Then you go out to the full year, we're pricing in more than 4 rate hikes. You know, we've seen 2-year yields just really going for it. 10-year treasuries have started moving up. You know, we started to see a bit of a flatter curve, but ultimately, you know, the NASDAQ's responded to this, the Russell's responded to this. You know, I talk about my thesis in gold, which I think is actually a hedge against a policy mistake. And I think, therefore, it's a really great question to ask you. I mean, with such rich pricing and such elevated expectations, when so much of the inflation has been caused by supply side shocks, how much should we be concerned with this pricing if it does become to fruition that further down the line that we could actually see a policy mistake from central banks?
Well, so I'm glad you brought this up, Chris. You know, this last week I was doing an interview with a gentleman by the name of Jim Welsh of Macro Tides, and I was trying to figure out myself how the market could be more. How could they get more hawkish from here, or how the FOMC could get more hawkish, or expectations? And he said something that was rather interesting. He said he thinks that the Fed's going to front load rate hikes. And I was like, oh man, I don't know. That's a tall ask. And here we are this week, you know, with this, now people are starting to price in the fact that the Fed might actually raise rates a little bit more aggressively. And people are now starting to talk about it. And I was like, yeah, maybe that is something we need to worry about. So I don't know, Chris, I'm looking at, you know, when you see yields rip higher and bonds drop and break down, seeing levels that we haven't seen since 2019, I'm starting to think maybe that is what the market is expecting. What are your thoughts?
Well, I think, look, the moves, the breakout that we've seen in gold, the breakout in silver's just gone for it, up. and palladium as well. And why are they doing that? Well, they're saying to me that they've just completely separated from real rates and nominal treasuries. They had a very strong inverse correlation, but that's broken down. Why for me? It's because the market wants gold in their portfolio, 10% allocation, because they're saying, if they get it wrong, there's going to be a big pivot from these central banks and gold is going to absolutely rip. So they're front loading that situation. You're buying gold, you're buying precious metals in case of a policy mistake. Now, obviously the Fed will be reactive and I think people are looking at the S&P, the NZDUSD and the drawdown we're seeing there and saying, well, look, these are the markets that'll tell us if they think that the Federal Reserve are getting this wrong. And of course, we know there's a Fed put in there somewhere. The question is how far it goes down. So the concern for us is if the equity market pulls back, rates pricing will come out as people go that they're over. So I think listen to the markets, but gold and silver really telling us quite a clear message this week, I think.
Well, it is. And actually, that's what I wanted to bring up next. Since you were on the topic of, bonds and what the bond market's doing, which obviously we look at yields being the inverse of that. I actually wanted to draw our attention over to the US dollar Japanese yen, which has had, especially in recent months, a very strong correlation to the 10-year yield. And as 10-year yields have broken higher, the dollar yen would break higher. And, we were trading at multi-year highs just literally a couple of weeks ago on the dollar yen. But the thing that's happened this week is we continue to see a rally in yields. I think when since it was Martin Luther King holiday here in the U.S., I wasn't paying as close attention to the markets, but I looked on Twitter. Somebody said, yields are 10-year yields are limit up or, bonds are limit down. I forget what the tweet was. And I was like, man, I looked at the 10-year and they were ripping higher at the beginning of this week. I looked at the dollar yen automatically because, Pavlovian behavior would have me look at the dollar yen, and the dollar yen hasn't responded. So now you're starting to see the yen respond like gold more to maybe a policy misstep by the Fed. It's starting to strengthen. We're seeing the dollar yen go down as yields go higher. And I was always looking for that. Where was that point where the market starts to trade the dollar yen a little differently? And I think we're there. What are your thoughts on this? This behavior in the dollar yen?
Well, Pavlovian, it's one of my favourite cakes. I was getting a lunchtime, but rubbish gag, sorry. We've got a situation where I think you're going to see dollar yen moving similar to sort of what we've seen in gold. And that is the sense that these market pricings have become so rich in terms of expectations, and probably rightly so. You've got 7%. Inflation rate in the US, you've got obviously full employment. The Fed need to act. There's no doubt about that in my mind. The Fed need to do their job, and I think they are doing. They're making noises that they're going to do their job. The question now is will, I don't think you're going to see anything higher. I just don't think you're going to see higher rate pricing in there. So if the market senses a slowdown, if we see, some of the data points, we're already seeing that. The New York Fed numbers were awful. The manufacturing numbers there. Retail sales numbers were recently quite poor. If they start raising rates and we see business and consumer confidence getting smacked as a result of higher Fed funds rate and higher expectations of interest rates, when it's been a supply shock that's hit us, do you know what's going to happen? Rate hikes are going to come out the market and dollar yen's going to go down. So the market will tell you, equities will pull back and rate hikes will come out, dollar yen's going to go down. So I think tactically, I'll be looking rallies to sell into dollar yen in my opinion.
Okay, so you don't think that if the rate hikes will come out of the market, the dollar yen won't rally then on risk appetite then?
We could. Look, that's an interesting situation for sure. But I think given it, I think its correlation with rates and yields will be there. So it's a great question. Dollar yen has been obviously related to it, but no, do you know what? There's a better trade out there, Blake. Aussie dollar would probably be a much better trade than dollar yen in that situation. If the market rallies because of that, then Aussie yen would probably be a much better trade to look at as well. So obviously one to look at.
There you go. Well, since we're talking about weird moves in the markets and correlations that aren't really jiving, I really wanted to talk about emerging market currencies, because what we haven't seen, Chris, is we haven't seen the emerging market currencies respond well to, or actually, let me take that back. As stocks have been going down, usually emerging market currencies tend to just get pummeled. And we've seen that dynamic all of 2021. And this year it's been a little different. And as stocks have come off, emerging market currencies have really held their own. And I haven't been able to put my finger on exactly the whys that emerging market currencies have really performed well. But I'm wondering, is this an opportunity? If stocks continue to get hit, do we start selling emerging market currencies? Because that's typically the correlation that I play into. And I wonder if it's just more lagging right now. What are your thoughts on emerging market currencies and how they're performing at the moment?
Yeah, you're right. I think you bring up a really good point, and we can look at EM in specific isolation. What's happening in Turkey is very much idiosyncratic of what's happening in Turkey.
Yes.
And the Turkish lira has found some stability. But generally speaking, I think what you're doing is you're seeing a separation between this kind of risk on, risk off vibe that traditionally has plagued EM. So when you get to tighter financial conditions, emerging market currencies would get smacked. That's obviously not happening at the moment, like you say, because most of these EM currencies are still hiking, and they're giving off the impression that they're going to hike at a much more aggressive pace going forward. So until we can actually see evidence, and it plays into this role of what we're seeing in the US as well, until we see evidence that this higher this higher Fed funds rate and the higher interest rates in those economies is starting to actually negatively impact economics, I think that relationship's going to break down between equity markets and EM currencies. So we're still looking at that support to EM currencies in this backdrop of rising rates from lots of LATAM currencies in Europe as well, in some of this EM currencies there. So I think while we're still expecting much more rate hikes to come through, you're going to have that separation breaking down between risk appetite in equity markets and that need to sell EM currencies. So certainly that's my thesis. I think that people will be buying dips in EM, but when we get that turn, if we do get the turn that the people think the policy mistake from the Fed comes in, then I think EM absolutely rips. But we're not there yet. I mean, so similar sort of to the thesis what I have in gold there. So what about you? Have you got any thoughts on that?
Yeah, and I do, just because I was thinking, it probably has a lot to do with flows, I'm assuming at this stage. But you're right. If we do start to see the market reprice what the Fed is doing, then EM does rip. I'm looking at the US dollar to South African rand. It's back at support where I've played it on the long side as a big inverted head and shoulder pattern. I've been trying to nibble at it down at these levels and be long the dollar against the rand again. And I'm not getting paid to do so. And so I'm wondering, maybe the rand takes a turn for the better and starts heading higher.
Well, I think the other thing, just quickly, we're going to talk about crude in a sec, because I think that's been on the way. But one of the things is there's been such a massive concentration in positioning in US tech. These monopoly businesses, high growth companies, and the money is moving out of that area. So international funds have been parked in US tech. That money is being redeployed around the world. That's why the US dollar is not strengthening, in my opinion, on the back of this move that we've been seeing in yields. And some of that's going back into EM, and I think that's keeping it supported as well. So that concentrated dollar position that we've been seeing in tech, I think, is now being redistributed, as we've seen with the Russell coming down and also the NASDAQ getting smacked now. So you've got to think it comes into your point of flows there. But have a look at crude as well, because crude's been one of the big talking points as well. We saw a break of that October, those October highs. For a large period of time, it held that yesterday, and I think we saw news that there'd been this pipeline explosion between Iraq and Turkey that was accounting for 450,000 barrels a day. Through this session, in the session that we're talking about tonight, your session today, we have seen a few sellers kick in, and it's closed below that October low. So is this a start? Was that a fake out? Is it a powerful move? I think that the crude market's been super bullish, right? Everyone's talking about $90 because the fundamentals have justified it. You've got underinvestment. Most of the OPEC nations are not living up to their output quotas that they should. They're actually well under. You've got a scarcity going on at the moment. Demand looks like it's going to pick up. So there's a whole host of reasons why crude should be where it is at the moment. But, I know you've been watching the crude market very, very closely. We failed to close above that October high. It's a failed breakout. So, what do you think about this? But it's been something that's resonated across the spectrum. High crude prices have played into the bond market, into the equity market. It's really important, right?
Yeah, it is. But let's not forget, this is something that you identified last week, Chris, rightly so. You were identifying crude and how strong it was and how it might hit the $86 level, the recent highs. And if I remember correctly, you were looking to sell these levels. Now, here's the thing. This is a setup for me a little bit later on in the show, so I don't want to go too far away from this. But I do say that I will say this, that I think that crude is going to be following risk a little bit. So as risk appetite wanes, I think crude oil is going to back off of these levels. And I think that, high prices are going to end up weighing on crude.
But you don't think
eventually.
You don't think that crude is driving risk sentiment? So you think that crude is actually being dictated to by risk sentiment? I take the view that perhaps it's driving risk sentiment, and maybe this is the head and the market is effectively the tail. What do you think on that one?
Yeah, I don't know. I'm kind of thinking the opposite, but then again, every time I turn around, I think crude should be pulling back here. It legs up another notch higher. So who knows? But I will tell you this: it is one thing that is supporting risk. If there's anything out there that's keeping probably the S&P above the 4,500 level, is crude at these levels.
Yeah,
that I'd have to argue.
No, absolutely. And I think the energy sector's just done really well. So we've been talking to clients about this idea about being able to play long-short strategies. We talked about a long-short strategy of Berkshire Hathaway against the ARC Innovation. That trade's worked beautifully. But I think the other trade that if you want to play it for equities is long the XOP and short the SPY, which is the S&P ETF effectively. And that trade's working well, and you're playing energy effectively through that. So that trade's working well. But yeah, I mean, we're at these key levels at the moment. It's make or break time for the oil price at these levels, and I think that's something. If it does break out and holds it and starts trending, we're going to be talking $90. But I've been looking to sell into these levels, but the price, we just need to see it looking a bit more vulnerable now, and I want to see it roll over a little bit and heading a little bit lower in the short term. But we are at key levels. Crude has to be on everyone's radar at the moment, and we're going to go into some of the charts now and have a look at some of the intricacies that we're seeing, some of the flow, some of the price action, the technicals, the patterns, and let's go into that's a setup. Okay, let's chat gold. We get a lot of requests for people to talk about gold, and the setup looks absolutely phenomenal in my opinion. We're not quite there yet, Blake, but you've got that kind of rounded bottom. I've got a weekly chart there because it gives great oversight. We can trade in and out of those positions. We're trading off daily charts as a swing trade, or whether you want to take that really down and go into some sort of day trades or scalps. Overall, you've got to look at the rhythm, the feel of the weekly, and you've got that, what looks like a cup and handle, but we've got a kind of broadening megaphone that comes on the right-hand side. We've broken through 1830, which is the recent swing high. The bulls are in control of this, but it does need to break that downtrend, those series of lower highs that we've been seeing. It comes in around 1850. If we can get a close above that specifically on a weekly basis, for me, that's when the trend followers come in. The CTAs, the systematic guys, are going to start dripping length into this market. Gold is underloved. It's under-owned at the moment. You've seen that in the positioning. You see that in the optionality. A break of 1850 and the swing that we got into late Q4 of last year. Then it trends and it starts trending high. Gold is a hedge against a policy mistake, not an inflation hedge, a policy mistake. And that's why people are moving, and that's why it's diverted there. I love this setup, but it needs to complete and it needs to go through 1850. What are your thoughts there, Blake?
Here's the thing about gold, that you throw out the number 1850, but the 1850 level is the 78% retracement of the that would be November highs to December lows. So really a breach above that on a closing basis, as you pointed out, I think really puts at least the 1900 level back in play. But I love basing patterns like this. I love cup and handles. I love accumulation like this. So I'd agree. And gold has every reason from a macro perspective to be going higher. Just from inflation expectations to rates moving higher, gold should be moving higher. And maybe this is the early stages of it making that move. So I like it. Yeah,
I like it too. And I think maybe it's a relationship about Bitcoin and people, wanting Bitcoin over. I think that's kind of broken. Silver though, I haven't got a chart of silver, but go and have a look at the daily chart of silver. It just looks beautiful at the moment. I know it's the high beta cousin of gold, but if gold's going to go up like this, I think silver's going to go up at a high base. So I think this needs work. It needs to complete, but this has to be on everyone's radar at the moment.
All right. Well, my next chart I wanted to bring up to you guys is the dollar CAD, and the dollar CAD. A lot of people, and I've seen it all over FinTwit. Everybody's looking at this dollar Canadian head and shoulder pattern. And, if there's one thing that I've learned over the last 25 years of looking at charts and analyzing charts technically, is that if there's one pattern that's going to fail on you, it's the head and shoulder pattern or the inverted head and shoulder pattern. So what I mean by that is I don't think it's going to complete. Actually, I see it more as a wedge. And you can see that wedge has allowed us to make a move down to the ascending trend line that comes in right around the 125, 124.50, 60 level. And you'll notice that today we made a lower low, but then closed higher. We closed above the 200-day moving average, and that's a 50% retracement. And, being the 50% retracement and the 200-day moving average and a possible double bottom false breakdown, I think the risk is that we move back up towards 126. I think the dollar CAD is taking its cues off of crude oil as well, because the turn in the CAD happened when crude kind of peaked intraday as well. So I think that's this dollar Canadian setting up. Now, if it does break below 124.50, that's a pretty clear indication that we're going back to 123 and possibly the low 120s, like 121, 120 and a half. Yep. So if you're looking to get long, this is probably the place to do it. What are your thoughts here,
The other thing there you've got to look at is the Bank of Canada meeting coming up on the 26th for you guys, 27th, really early in the morning. Market's pricing a 62% chance that the Bank of Canada raise rates. If they don't raise rates, you're going to get 126. They're going to that CAD pricing's going to reprice, and dollar CAD's going to rally. And of course, you've got the Fed meeting as well the day after. But obviously we're looking at 62% chance there that the Bank of Canada raise. If they don't raise, that dollar CAD's going up. Obviously, if they do, there might be a test of that trend line. But you've got so much different support levels to look at as well, and that's something that a lot of people should be looking at. But down to rates, and if they don't raise, then you're going to see some big vol, and dollar CAD's going to move up. And talking about trend breaks, well, let's have a look at what's going on in the R2K or the Russell 2000, or what we call the US 2000 here at Pepperstone. And you can see on the trading view chart there that this has held a range. We talked about this a couple of times on the show in 2021, but you've got this trading range that had been really holding since February. We saw that failed breakout in November. A lot of people getting bullish, including myself, on the back of that, and it obviously proved to be a failed breakout or a fake out, that it came back to test the range. You can see that on the B, that we had that little bit of a rally, but we've now broken the range. And again, the two questions you've got to ask yourself here is, are we going to see a similar situation, obviously inversely to what we saw in around letter A, where we obviously had the failed breakout? Is this going to prove to be a failed breakout to the downside on this trading range in the Russell, or is this going to start bear trending? Of course, for people who are trend following, people who are trading on the momentum, we can look at short positions at the moment, and then obviously if you get if it comes back, you get stopped out, and you obviously don't lose a lot of money. That's the idea here. But if this starts going, this could be trading down at 1900 fairly soon. That's something we are looking at. It's a bit oversold. You can see that from the various oscillators. I've got the rate of change, I've got the RSI, and where it sits in its Bollinger Band on that third oscillator there. But you can see this is broken out of its trading range at the moment. A lot of people are talking about this one now. Is this about to go down to 19,000, or are we going to see a failed break? I quite like short positions at the moment and getting stopped out for a small amount. What do you think, Blake? You got any ideas on this one?
I just think that these false breakouts lead to breakdowns. I love it when traders get caught wrong-footed, because it usually swings the other direction. Look, I'm a trader. I'm a predatory trader at that. That's what we all do. So when you catch the majority of the market caught off sides, that's a good trade. And so to play this to the short side makes a lot of sense to me. And so I think that, your lower levels where you have A, B, C, D, or X in this case on your chart, I think that's a realistic expectation for this next move. Yeah,
I think this is one that's been on a lot of people's radar, getting a lot of notice. So I think everyone should be taking notice of this range break. The longer they are, those ranges, the more meaningful they are when they do break down.
Well, speaking of ranges, let's take a look at the Kiwi. Now, this isn't necessarily a range, but what I can tell you is that's a bear flag pattern, and it has all the characteristics of being a bear flag setup. The reason why is we've seen this consolidation. This consolidation's really lasted since December of last year, and we have barely been able to reach the 38% retracement. That is very characteristic of a bearish consolidation. And so all I'm waiting for now is a break below 60.6740, 6740. And that's going to open up the downside. And I think there's a lot of people that are bullish Kiwis expecting for a much bigger move higher. And I'd hate to be the one to say this, but we break 67 cents. I think we're going to see 64 cents before we get anywhere near 70 cents. So what are your thoughts here, Chris? I mean, this is a pretty bearish price action in the Kiwi.
Yeah, I mean, I've been looking at Aussie Kiwi. I know a lot of people hate that cross because it's slow beta. It's it doesn't really move as aggressively as you would do in Aussie dollar, Kiwi dollar, Kiwi yen, for example. But that's pushing right up to the top end of its range. And whilst I'm not necessarily like a huge Aussie bull, I think that if that breaks through, that could be a really interesting trade from the long side. But I will say fundamentally, the next RBNZ meeting doesn't happen till the end of February. It comes out on the 23rd of February. The market is already pretty excited. We've got a 27% chance that we get a 50 basis point hike. So 127% chance of a hike effectively. Now, I don't think they're going to get a 50 basis point hike. I think we're going to get 25 at the most there. So fundamentally, you've got to see a bit of rates pricing coming out of the Kiwi. It tells us that potentially we're going to go down a little bit there. It's probably a risk-off story. But yeah, I mean, absolutely. The price is always true when you're trading currency markets. It's the aggregation of flow. If it breaks, it breaks through that pattern, the flag pattern, it goes down to, I'll be looking to go short. If it breaks then at 67, I'll probably be ramping that up. Maybe it goes down to 64. I probably wouldn't trade with a target, but, I think that the price action needs to be respected. I think that's a great setup to look at today. So, really interesting one. Thanks for bringing it up. So let's go to the next section, which is going to be our play of the day. It goes back to the breakfast ETF, and that's why I brought it up, because lean hogs, it's just a setup that I just think is fantastic at the moment. What I like about these commodities, these kind of agricultural soft commodities that we see, is when they trend. These guys trend like no other asset class, in my opinion. They really go and just go in a continuous motion, whether you're looking at orange juice, whether you're looking at oats, all these kind of factors, coffee. Go and look at the daily chart of coffee at the moment. That looks really positive as well. What we're seeing at the moment is this really big move up in commodity markets. And what I like about this is you've had this basing pattern after a drawdown that we saw in Q3 of last year. Now, we've just sort of traded sideways, and you can see the Bollinger Band there, 2 standard deviations of the 20-day moving average. That's just started to turn. We've got price closing above that top end of the range. You can see the top oscillator there is the rate of change, best momentum indicator that I reckon that you've got out there. You've got the RSI moving higher, and it's closed above this. This could kick on, and it could kick on hard. So this is one that I like to be long. If it closes back below there, I'm getting out very quickly. But if this goes, it could be fireworks there. So lean hogs, I'm an exotic man. I'm trading exotic instruments. This could really start trending going forward.
Look at Chris bringing home the bacon.
Yay.
I love it. Hey, all right. I'm glad you brought up crude. I really wanted to talk about crude because, look, I actually think this is a failed breakout. And I know that the highs back on October 25th were around the 86 level, but I'm really looking at the highs from like November-ish that were around 84.50 or so. It's that blue line. And if we close below that and we have a bearish candle going into tomorrow, I was thinking it was just going to be an evening star formation, but I actually, after seeing today's close, that was a shooting star formation. So I'm bearish. And look, if we can close below 84.50 tomorrow, meaning I guess today, I'm trying to think when everybody's watching this, but going into Thursday, if we close below 84.50, I'm looking for a 6 to 10% move lower. Right. Now, I don't think crude's broken, but I do think that we're going to see a near-term pullback. And I also have to mention that the overnight sentiment index, sentiment index came in at 92, which is very, very high. 91 or 92, one of those two.
Yeah.
So.
Great stuff. Yeah, interesting one. So Blake's looking at crude below 84.50. If it breaks through there, then they could be seeing a 6% plus correction. I'm looking at lean hogs, a bit more expensive, but you pay for the movement on that. And if that trends, that could be a really interesting one. We're watching the bond market very closely because the NASDAQ, the Russell are watching that very closely. Gold and silver starting to break out, but this is a commodity story more broadly. Remember, if you like what you've heard today, hit the like button, subscribe to the channel so that you never miss one going forward. If you've got comments about anything that you've heard today, any asset class that you think we should be covering in more breadth going forward, and if you just want to sort of comment about something that one of the views that Blake or I've talked about, leave it in the comment section. We'd love to hear from you going forward. But until next week, this has been the Trade Off, and so from myself and Blake, we wish you a good night.